So yes, good afternoon, and thank you for making time to join us. Our company is Pan African Resources PLC. My name is Cobus Loots. I'm the CEO, and joining me today is Evander, our Head of Investor Relations also. So we'll get into a presentation, and then we'll leave some room or space for questions, time for questions afterwards. We have the normal disclaimers and detail on forward-looking statements on page 2, and then we'll move to the overview of the presentation, which will deal with health and safety, which is obviously critically important to a mining company such as Pan African Resources. We will then proceed to give an overview of the group, give context on our operating environment in South Africa and elsewhere. Financial year 2023 is the current financial year. Some of the key features, performance by operation, group all-in sustaining costs, and then capital projects. Then we'll spend a bit of time on the environment, social aspects, governance, our financials, exploration, greenfields in the Republic of Sudan, and then conclude on the outlook for financial year 24, where we are very much, as always, focused on execution and delivery. If we then proceed to slide number 5, which is health and safety, group safety performance. We always say that we can't mine if we can't mine safely. That's obviously mining safety is critically important to the group, and we are working towards zero harm in our operations. And our safety statistics generally are very good. They are industry leading in South Africa, and that's a consequence of us having fewer people versus some of the really bigger miners in this country that employ thousands and thousands of people. And then also the fact that we source such a large proportion of our production from tailings retreatment, which is on surface and just inherently safer. So as far as health and safety is concerned, as I said, we are industry leading, and we have a number of milestones that we've achieved in the last year in terms of fatality-free shifts at all of our operations. We have had a bit of a regression at some of the underground mines, and we're working very hard to fix that, and certainly we expect a better performance as far as that's concerned in the year ahead. Then if we move to an overview of the group, starting on slide number 7. So all of our current operations are based in South Africa. We have 3 asset complexes, being the Barberton complex, the Evander complex, and then also the Mintails complex at Mogale. And I think what makes Barberton and also Evander quite unique is the fact that we have underground production, and then also have production, low cost, long life from surface tailings. And that's also what we'll be doing at Mintails at Mogale. So yes, the group, as I said, is mostly focused on South Africa. We have exploration in the Republic of Sudan that we'll spend a bit of time on. And then we have a nice production profile, we think. So gold is increasing in terms of production in financial year 24. And then with Mintails coming online in the next year, that is going to take us well over 250,000, or close to well over 200,000 ounces per year, and hopefully close to 250,000 ounces a year going forward. As I said, what we think makes us quite unique is that we have a blend of underground production, which is long life, and then also surface, which is mostly tailings retreatment. So, as you will know, South Africa has a legacy of more than 100 years of large-scale mining, which has presented this opportunity of retreating historical tailings and extracting the gold that was left behind some years ago. It's a very profitable business, and it also rehabilitates as we go along. So that makes us quite unique as having these two sources of production, both underground and also tailings. If we then proceed to our operating environment, slide 10. Some of you might be familiar with South Africa, and often there's a lot of talk around the electricity situation in South Africa, but we still have one of the largest grids of power or electricity in all of Africa. We've seen some improvements in the national grid and some certainly plans to improve the situation further. But the difficulties with electricity is also allowing us to focus very heavily on renewables. We were the first South African miner to commission 10 megawatts of solar power at our Evander operation, building another 10 megawatts at our Barberton mine. We've signed a power purchase agreement for a further 40 megawatts. And certainly our view is in the next years, we have every prospect to be up to 50% independent of the energy grid, or the national grid, so to speak. So that obviously helps us from a ESG perspective, also assists us from a cost perspective, being more competitive in terms of our all-in sustaining costs. Stakeholder engagement, or our social license to operate, is very important to us. We have multi-year wage agreements in place, so we don't have the risk of protracted labour or strike action at any of our operations. Our view is to go beyond compliance. So in a group, we employ our own people and contractors, probably 5,000 odd people. That's a lot of positive impact on the areas where we operate, areas that normally don't have a lot of employment. We focus on the lifestyle diseases to make sure our employees are healthy. And then we have a number of other initiatives where we also create employment in the areas where we operate. At our Barberton mine, we have a large-scale agriculture project that employs some 300 local women from communities surrounding our operation. And in security and public-private collaboration, when you're dealing in gold, you're dealing in a commodity that's very valuable and very prone to theft. So that's something we focus on. A lot of measures on physical security and cyber security, and then collaboration with government to make sure that we can continue to operate quite effectively. And I mean, this is our track record in terms of the energy mix in our portfolio. So as I said, first to commission 10 megawatts of solar. And yes, we're looking forward to ramping up that renewables footprint very dramatically in the years ahead. Key features from the last financial year and also from the first half of the current financial year, we actually started the 24 financial year very well. FY23 was not without challenge, principally because of the underground operations, and we made some changes at the underground mines. We converted Barberton into continuous operations, where previously that mine was only working a 5-day week, and we're seeing quite large improvements as a result of that change. And then, yes, we're seeing production being ramped up, which I think is very positive. We released a trading update a couple of weeks ago where we confirmed that we were very nicely on track to meet our production guidance. We actually upgraded our production guidance for FY24 to now 180 to 190,000 ounces, so quite close to that 200,000 ounce mark. The cost performance for the last year, just over $1,300 per ounce. Our guidance is to sort of pretty much maintain that performance in terms of costs in the next year. And then as we ramp up our new project, Mintails, we expect the group cost of production on an all-in sustaining basis to be reduced. Mintails is a very low cost producer. We're estimating $1,000 per ounce all-in sustaining. So that definitely will assist in reducing costs for the group. And in financial performance, it was a resilient year in the last year. Decent profit after tax, really good cash flows from operations. We have a strong financial position, very limited debt. And then dividends, which is key to our shareholders. We target a 4 to 6% dividend yield, and we're able to maintain that. And that sort of generates very decent returns for shareholders. If we then proceed to performance by operation, slide 15, which is Elikhulu. It's one of our flagships. Tailings retreatment, still long life, 10 years of production ahead. We produced 50,000 ounces for the last year. In the year ahead, we should do more. All-in sustaining costs just over $1,000, which is world class. As I said, 10 years life. It's also the site of our first solar plant. And then, yes, the added benefit with an asset like Elikhulu is we are rehabilitating the environment, and we're freeing up land for other development, agriculture, and communities as we go along. Elikhulu is also the blueprint for what we're doing at the Mintails site, which is our next growth project, and which we will discuss on the next slides. So, a very good asset, and it demonstrates Elikhulu that one can build successfully and commission projects in South Africa. This, when we commissioned Elikhulu, was a $120 million project. We built it in 12 months in South Africa. So again, that demonstrates one can very successfully build these large-scale projects in South Africa. If we then move to slide number 16, which is the BTRP. This was the first gold tailings plant we commissioned in the group. It produces less ounces than Elikhulu, and its life is fairly short. But this was the first plant, as I said, on the gold side, that demonstrated to us that we could successfully build and retreat tailings. I think the project capital was $30 million, and it paid itself back in 18 months. And the plan with this plant, which is still in very good condition, is to convert it to treat run-of-mine material from our Royal Sheba and Western Cross ore bodies at Barberton. So we've said to the market that we'll update the studies and come out with a fully fledged plan in the next months as far as the life is concerned for BTRP. So we expect BTRP to be running for many more years. This is Mintails, which is our latest project as far as tailings retreatment is concerned. This is very exciting for us. We now are in the throes of large-scale construction at Mintails. That'll be all done in the next year. So we'll be steady state producing by December of 2024. It's an asset that has a long life, 20 years plus, producing 50 to 60,000 ounces a year at an all-in sustaining cost of circa $1,000. So again, world class, and again, testament to the fact that one can successfully construct these sort of projects in South Africa. On slide 18 is the proposed project execution timeline, and as we've said, we're very nicely on track. The tower crane is on site. We're busy constructing the cyanide tanks, and this makes for a very attractive production profile over the 20 years of life. And again, this is a site that has historically a lot of rehabilitation liabilities. So as part of our ESG obligations, that we will be rehabilitating that and transforming this area into something that's a lot more acceptable in the years ahead. And I think then to conclude on our tailings business on slide 20, we're building a world-class surface tailings retreatment operation or business with an increasing profile in the years ahead. Really decent margins, and again, all of the added ESG benefits that these operations bring. If we then move on to our underground portfolio, Evander on slide 21. It's one of the largest unexploited or underexploited gold ore bodies underground in the world. We have 34 million ounces of resource. We're very successfully mining the 8-shaft pillar and transitioning into the lower levels, 24 to 26. Spending quite a lot of capital, which is going to benefit us over more than 10 years, 13 years minimum to be exact. And yes, it's one of the lowest cost underground gold operations in South Africa. As we've said, very good margins and a long life ahead. And then our Barberton underground, which is principally the Fairview mine. Again, world-class ore bodies here. We still, after many years of mining, Barberton started mining in 1886, and we're still discovering new ore bodies. As I said earlier in the presentation, we now move to continuous operations, which means we can generate more ore, generate more gold. And Fairview is really doing very well. We've increased the average monthly production from the Fairview ore bodies by more than 7% in recent years. recent months. So it's going to definitely impact our all-in sustaining cost and obviously our gold production also. So many years of profitable production from Fairview and from the other operations, Sheba and Consort, which historically have been high cost. Obviously, the recent run in the gold price makes these marginal assets now also even more attractive. But Sheba, we've converted also to continuous operations, so we've definitely seen an increase in tons, increase in gold produced, and then an increase in margins. And Consort, similarly, we've converted into a contractor mine. It's small, but it's washing its own face now. Then slide 25, the all-in sustaining costs. We're very competitive. We like to think from an all-in sustaining cost perspective. 80% or more of our operations produce at an all-in sustaining cost of just over $1,150 an ounce. And then Sheba and Consort, the higher cost mines, because of the continuous operation, we expect that cost to come down. So they should also be significantly more profitable in the next years. Just to demonstrate that, in our view, we are very comparable with the rest of the global industry. From a all-in sustaining cost perspective, you can see that we're very much in the sort of middle of the range in terms of the overall cost profile. And South African mines have a reputation for being high cost. And I think just this slide demonstrates that Pan African's operations are very competitive globally as far as the cost is concerned. Slide 28, capital. So we've been spending on capital through the cycle. And the beauty really is with our assets that are mature and generate a lot of cash is that we are able to reinvest in our assets and continue to, at the same time, expand. So a lot of very attractive internal growth projects, and then also return cash dividend to shareholders. And as far as our dividends is concerned, we're industry leading. I think I said earlier, targeting a 4 to 6% dividend yield on top of the growth, which we think is very attractive to shareholders. I've spoken a bit about ESG, but yes, I mean, we do a lot of positive, we have a very positive impact in the areas where we operate. Spoken about our renewable energy roadmap and strategy. We use very limited potable water in our operations. All of our rehabilitation liabilities are fully funded. So I think, as I said, we're investing heavily in schools, clinics, community projects, education. From a tailings perspective, independent audits in our facilities, and we're very comfortable with the state of our tailings facilities also. Slide 33, just a summary of the financials. The last year, as we've said, was lower from a gold production perspective. The guidance for the current financial year, FY24, has increased to 180 to 190,000 ounces. That obviously is going to impact our all-in sustaining costs also. But again, to emphasize on the slide 33, net debt, despite all of the capital programs we have, is very manageable. Just $22 million at the end of the financial year. You can see, again, the debt profile. Debt reduces despite all of the capital we're spending. I've spoken about the dividends, which is very attractive to our shareholders. A really good track record as far as dividends is concerned. And then from an upside perspective, we also have ventured into the Republic of Sudan, which obviously at this point is very difficult from a political perspective. We hope that the situation improves. Our people are safe and they're continuing the exploration. So our prospects are close to Port Sudan, so there's no violence or any threat from military action close to our operations or prospects. And yes, we would expect to have our first resource in the next 12 months or so. What we're seeing there is very attractive from a medium to longer term gold exploration perspective. And then to conclude on slide 39, very much focused in the next financial year on delivery and execution. Continue our focus on health and safety with an initiative to get to zero harm. We will monitor optimization and restructuring initiatives in our operations to increase gold output, reduce costs, successfully execute into our capital projects that will sustain and increase future gold production. We will ensure adequate liquidity to fund all of these activities, continue to pay the dividend, progress our Sudanese exploration venture. ESG initiatives continue to be very important. Renewable energy, as we've said, we'll roll out even more projects in the year ahead. And then maintain our focus on generating sustainable shareholder returns. So that, in summary, is Pan African Resources, and thank you very much for joining us.
Thank you for an excellent presentation, Cobus. We will now proceed with the Q&A session, which will be divided into 3 parts. First, the management and board, which discusses Cobus' track record, Pan African's history, and the people at Pan-African. Thereafter, we will discuss Pan-African's asset base, with a focus on Mintails, which is currently under construction. We'll also touch on measures to reduce cost and ensure power supply. Finally, we'll discuss how Pan-African plans on deploying its generated free cash flow and how South Africa is as a mining jurisdiction. Cobus, could you tell us about yourself and your track record?
Yeah, so I've been a director of Pan-African since 2009, been CEO since 2015. Companies in that time gone through a number of changes. We've built some large projects. Very excited, as we've said, about what we're doing with Mintails. But it's not about me, it's about the team, and we've built a competent, credible, and very experienced team. We're known in the industry for execution, for messing up projects, for delivering projects, and for doing what we said we would do. And that's really the track record that we will build on in the years ahead also.
Cobus, could you walk us through the history of Pan-African Resources?
So, yes, I mean, the company started out as an exploration business in the early 2000s. And the first asset it acquired because of effectively a corporate restructuring was Barberton Mines. And that asset, as I said in the presentation, has been going since 1886. So it's one of the oldest running gold mines in the world, still with a life of more than 20 years. And under the auspices of Pan-African, Barberton has gone from strength to strength. We've commissioned the tailings project. We've commissioned a number of growth initiatives. So that was the genesis of Pan-African. We then acquired the Evander complex from Harmony, and we grew that complex also with the addition of the Elikhulu tailings retreatment operation, which was a large capital project, $120 million, the largest project we had undertaken until that time. We expanded the underground, so still long life on the underground. We've added renewable energy into the mix to make that operation more sustainable. And then recently we have the Mintails project, which has added to, I think, the attractiveness of the group. It's going to add short-term, long life, low-cost ounces that will be brought into the mix in the next 12 months. And then obviously we ventured into exploration again in the Republic of Sudan. So that's the history of the group. We are listed, as you know, in Johannesburg. We're listed in London and then also in ADR into the US. And yes, I mean, we're quite proud of some of the achievements. I think recently we were awarded one of the top 10 companies on the JSE in terms of shareholder return over 5 years. So that's something we'd like to work on and improve on even further. I think a couple of weeks ago, we were awarded again on the Johannesburg Stock Exchange the top company in terms of smaller cap from an annual integrated report perspective. So a number of recent awards. I think it also speaks to Pan-African and the way we do things.
Could you give us an overview? How have you, as CEO, built the management team and board at Pan-African?
Sure. Well, we have a good board with very experienced individuals. So the guidance in terms of strategy and execution is obviously comes from the board. We have a small board that's very efficient. If you look at the number of meetings we have quite a number of meetings, more than the requisite minimum, just to discuss and to make sure everybody's on the same page, and that's part of our culture. We have a flat management structure where there's not a big corporate office, very few people in the corporate office. Most of what happens at the operations. We make decisions quickly, and people take responsibility and accountability for what we do. And that's our corporate logo is the African honey badger, which is not the biggest animal, but it's quite ferocious. It's tough. It's tenacious. And that's the way in which Pan-African views itself and our people.
Could you give us an overview of Pan-African's ownership, retail, institutional split? Who are your largest shareholders?
We have a number of future institutions that have been long-term shareholders in South Africa and in the UK. The likes of Investec, Allan Gray, the government pension funds in South Africa, a number of the income funds, specifically in the UK, that like the dividend. And then we're growing that shareholder base in the US also, which we think is very prospective. So we like to think we have a very nice mix of long-term supportive institutional shareholders, retail shareholders, and then other shareholders that like the growth and the dividends.
How active is your largest shareholder, Allan Gray, in the decision-making at Pan-African?
Well, they're not active. The board owns the company, and Allan Gray, I think, owns some 18%. So they're an arm's length institutional shareholder, and we see them twice a year after the final and interim results.
We'll now move on to Pan-African's assets, where we will begin by discussing Pan-African's measures to reduce costs and ensure electricity supply, which is an issue in South Africa. Thereafter, we will put focus on the Mintails project, which will provide significant near-term growth. We'll also touch on some of Pan-African's other operations. With that, I would like to move on to your assets. And first, before we move on to your individual assets, I would like to talk a little bit about electricity, which is a considerable issue for the mining industry in South Africa. What measures are you taking to ensure sufficient electricity supply?
Well, like I said, we are investing quite heavily in renewables, and that's really good from an ESG perspective. So certainly reducing carbon emissions, but also it makes business sense. I mean, the first solar plant we commissioned at Evander, which we were the first South African miner to commission a large-scale project of that scale and size. The payback on that investment, so the initial investment was about $10 million. The payback is 4 years. So obviously it makes business sense. And yes, I mean, we'll continue to invest in renewables. And there's a slide on our roadmap and how we plan to sort of be up to 30 or 40% independent in the next years. But the current situation as far as our national utility is such that we can manage it. We can manage successfully and operate. And we don't see the situation getting much worse. So that means we can continue to operate. And obviously the electricity situation in South Africa is very well publicized, but it's important to understand, I mean, it's still much better than most of the rest of Africa. Most mines in Africa have to provide their own power. It's not the case for us.
I think you will add up to 30 megawatts of capacity from your renewable or solar plants. But what is your total electricity use?
At the moment, it's about 80 megawatts. As I said, we have 10 that are operating. We're building another 10 that will be operating by June of next year. We've signed a power purchase agreement for 40. And then we'll do a range of other expansions. So we're quite excited about the future as far as renewable energy is concerned.
Inflation has been an issue. It has compressed margins in the entire mining industry. Yet, except for Barberton underground mines, Sheba concert, you saw little year-over-year in cost inflation in the last financial year. What measures are you taking to reduce costs, both operating capital and central G&A costs?
Well, the best way of reducing your unit costs is by producing more ounces. Certainly our guidance has increased in the year ahead. We've now upped our guidance to 180 to 190,000 ounces for FY2024. So our year end is June, as you know. And then the year thereafter, with Mintails coming online, that's going to very much also assist us on a unit cost basis, as Mintails is expected to produce at $1,000 an ounce. So yes, the continuous operation at Barberton is reducing unit costs. The renewable energy initiatives is reducing costs. Additional exploration or production from the other assets is reducing costs. And we've always had a culture of cost consciousness. So it's not something new to us. We continue to save wherever we can. But we also, importantly, we continue to spend capital to make sure that our assets are sustainable. And we've been spending through the cycle. So none of our assets are undercapitalized. We've been spending the requisite amount of capital. And again, I think that demonstrates the quality of our portfolio, is the fact that we're able to spend capital, we're able to grow, and we are able to pay what we think is an industry-leading dividend to shareholders.
As you mentioned in the presentation, you have a significant growth profile through the Mintails project. Could you give us an update of the progress of the construction of the MTR plant?
Yeah, so again, the update we put out some 2 weeks ago confirmed that MTR is very much on schedule, on track, on budget. We will be steady state by December of next year. By December of this year, we would have pretty much fixed 80% of all the costs. That means that there's very little risk of project inflation. But we have a great track record on these plants. It'll be the fourth large-scale tailings plant in the gold space that we build, and all of our projects have been on schedule and on budget.
Speaking of on budget, so the initial capex for Mintails project is $135 million. Could you explain how are you funding that?
Innovative structure. There was no call on shareholders. Again, despite continuing to pay dividends and to continue to reinvest in the rest of the portfolio. So there's a dedicated facility of about $80 million. Project facility was $80 or $70 odd million. $70 odd million, and then we issued a sustainability-linked bond for the remainder, and then we did call it a synthetic forward sale of some of the gold. So we only have about a year left on that forward sale. So the entire project is fully funded, and it was done without any recourse to shareholders.
How could you potentially increase Mintails' production profile from its current 50 to 60,000 ounces of gold per year?
Only some of the facilities that are positioned in Mogale, and that was a 13-year life. But we actually, if we include the second cluster, which is Soweto, it takes the life of that project to more than 20 years. So if you think about the initial capital of $135 million, we estimate a payback on that of some 3 years. At the current gold price, maybe even less. We think that's a very attractive sort of profile where you're going to be producing for more than 20 years at our estimate is $1,000 an ounce. Payback on the initial capital 3 years. I mean, the cash flow generation will be very attractive. And then there will be scope to add to that. I mean, we have a large site for deposition. That means we can add further tailings and expand that operation in time.
So if we look a couple of years out and look at Elikhulu, you have a planned expansion for Elikhulu in a couple of years. So you will be switching over to Winkelhaak tailings storage facility. What capital investments do you expect you have to commit in that switch?
Sure. Look, I mean, last year we switched over to some of the facilities that we call Leslie Bracken, and it was done seamlessly. There was no impact on production. All of the capital is fully funded internally, and that is still the asset generates return. So to move over in Winkelhaak, that only happens in some 3 years from now. The total capital for that transitional move is about probably $20 million. And again, an asset is so cash generative that you can fund all of it internally and still pay a nice dividend.
What recovery rates do you expect for Winkelhaak?
Well, we expect the grade is a bit lower than what we versus what currently treating, but the recoveries are higher. So we expect to be producing the same level of gold, so 50,000 ounces plus a year for many more years.
Could you add some color on how you plan on accessing the Royal Sheba ore body, and what initial capex do you think would be associated with that?
So we've said to the market that we will update and put out the detailed studies in the months ahead. But the capital initially is not expected to be significant in the bigger scheme of things, probably $15-20 million. And again, it's important to understand these ore bodies. Some other miners would build an entire listed company around an ore body like this. It's just, I mean, we're quite spoiled at Barberton. We used to mining no less than 10 grams per ton on average. Royal Sheba for us is lower grade, some 3 grams per ton. But yes, we can access Royal Sheba. We have a decline. We're actually on the ore body. So it's just making the development decision and then starting the development and the mining. And as we said, the BTRP at Barberton is very well suited to treating this material.
Will it access by a decline or a shaft? Or
there'll be a decline going down, mechanized, very few people, and then we'll utilize a massive mining method, probably long hole open stoping. And again, it's been successfully tried and tested at Barberton.
How are you thinking in terms of executing the Egoli project at Evander?
So yes, I mean, it's no different to what we're going quite slowly on the Egoli project. We have a long life on 8 shafts, 13 years. So it's just additional upside. funded internally, so there's no, again, massive debt that we're incurring. And we just think it's an attractive project with quite a lot of upside in the years ahead.
Barberton underground mines consist of 3 mines. It's Fairview, it's the Sheba, and it's the consort mine. Could you summarize the efforts that you're taking to improve productivity and profitability at these 3 mines?
Well, it's quite simple. We've changed Sheba and Fairview to continuous operations. It's probably one of the last remaining assets in South Africa that was only mining or operating 2 8-hour shifts 5 days a week. So we've gone continuous operations, which means that we have a lot more face time, and tons are up. It means also that you can mine lower grade and still be profitable. And I think we detailed some of those successes in the last presentation. Tons are up and gold is up. Consort, which is a small mine, but still a lot of potential. If you might remember, some 4 or 5 years ago, even though Consort's been going for so long, we developed into an area that was new, and it was 4% gold, or 40,000 grams per ton. So we're doing a lot of exploration at Consort, and we've converted Consort into a contractor mine, reducing overheads and making sure that we do more ounces. So yes, we very much expect Consort going forward to add margin also and add profits.
If we move on to Sudan, so what are your plans for the exploration concessions in Sudan?
So obviously we're going a bit slowly in Sudan given the political environment, but it's very prospective for gold and other minerals. I actually just come back from there. I was there for a week, just looking at our tenements and what we're doing on the ground. We have the largest assaying laboratory in the country that's operating at this point very successfully. We have a good team of geologists on the ground. And yes, I mean, I'm very encouraged by what we see and the prospectivity. And we've done a lot of sampling, we've done a lot of testing, aerial surveys and the like. And I would hope that we will put down our first drill hole in the next 2 months or so and prove up a resource.
Would you add some color on what you think the size, I know you can't speak too much, but the size and the potential grade of this resource in Sudan?
Well, it's early days, so I don't want to speculate, but we are seeing a lot of artisanal activity on our ground. We've seen, we've put out some of the grab sample results. And yes, I mean, you can imagine if we can get a 2 gram per ton ore body on surface, 1 million ounces, and again, that's some way off, but we think there's very little doubt that there are large resources and reserves. It's demonstrated by, I guess, the work of others in that area. Perseus went and bought a Block 14 from Orca, which was a Canadian company, and they had a very large reserve.
We will now move on to talk about higher level strategic questions, where we will touch on the pros and cons of operating in South Africa. We will also touch on permitting, local community relations, capital structure, debt, and how Cobus plans on deploying Pan-African's generated free cash flow. Finally, we will ask Cobus about his vision for the company. How is South Africa as a mining jurisdiction?
So there's a lot of criticism and a lot of negativity around South Africa from an operations perspective, but I mean, we're quite comfortable operating here. Importantly, all of our mining rights are long dated, so Barberton's right is valid until 2038. Or it's Evander that's valid until 2038 and Barberton until 2050. Again, I mean, we've spoken about the electricity situation and how we're able to manage that. We've never had any protracted labor issues, so we work well with our people, we work safely. And yes, we're comfortable to operate here. There's no issues with repatriating funds. We have a sophisticated legal and taxation system. So yes, I mean, we're quite happy operating here, and we have a long track record. I mean, our Barberton mine has been going since 1886, which is almost 140 years.
How difficult is permitting in South Africa, both for exploration and exploitation license?
In our view, it's actually one of the most efficient places to get permitting done. And an example on this is Mintails, which if you think, I mean, it took us about 18 months to waive all of our permits, which is exceptional. Very few places in the world where you'd be able to get a project shovel ready in that short space of time.
How are your local community relations at all of your sites? Have you had any issues with protests?
Well, we have some protests, but it's really the minority. The majority of people recognize that our mines operating there is just massive benefit to everybody. Again, from an employment perspective, economic opportunity, and everything else. So, an example of what we do also is I mentioned the large-scale agriculture project at Barberton, where we produce blueberries, we make a bit of money, and we employ 300 local women for almost half the year. So those sort of initiatives also buy a lot of goodwill from communities. So yes, I mean, we have generally excellent relationships. We've never had protracted issues as far as stoppages is concerned because of community.
Could you walk us through your borrowings? I mean, you have a revolving credit facility, you have the DMT and bonds, etc., and explain the interest rates and amortization schedules that you have on these.
Yeah, so we have, as we said, the DMT medium-term bond. There's about, on the one tranche, the majority, there's about 2 years remaining, and then there's another tranche that has 4 years remaining. But, I mean, we don't see any difficulty in refinancing that when it becomes due. Then we have a revolving credit facility, and there's some detail in the presentation. There's no imminent refinancing issues there. It's also long dated, valid for a number of years. And then we have the project facility for Mintails, and that also was designed to pretty much be repaid from cash flow generated from Mintails. We expect quite a lot of excess cash being generated by Mintails at the same time.
I mean, as said in presentation, Pan-African pays a high dividend relative to its market cap. Could you explain Pan-African's dividend policy?
Yeah, so we have a policy which really is based on free cash generated and paying out a percentage. I think it's 40% minimum of cash generated. But, you know, we also have a look at sort of previous payments and what we need to do to keep ourselves competitive. And, I mean, nothing speaks like a track record. And I think our track record in terms of dividends is very attractive.
So once Mintails or Mogel is in commercial production, how are you thinking in terms of deploying your generated free cash flows? I mean, there's still potential for continued organic growth for your other sites, M&A, increasing your dividends perhaps. Could you add some color?
One of those, and if you look at what is a good measure is our return on equity. And our return on equity is Pan-African generally sits between 20 and 30%, which is very good, we think. And we also think it demonstrates management ability to successfully deploy capital, and that's what we'll continue to do. Again, we in a fortunate position where our assets are long life. We don't have to go and buy something if it doesn't make sense. We have a lot of organic growth we can still do in our portfolio, and we'd love to pay shareholders more, and that's a good driver for the share price, increasing our dividends.
And with that, we're actually arrived at my final question, which is, where do you envision Pan-African Resources in 5 years?
Well, we'd love to continue to grow the company, diversify the portfolio further, and create value for all of our stakeholders as we've done. So we have a good track record, and again, we don't have to do anything differently. We'll continue to work on the same lines, create shareholder value, mine safely, profitably, and grow our business.